Late last year, the Biden administration's Federal Trade Commission blocked yet another merger, Tapestry's $8.5 billion acquisition of Capri Holdings. The deal would have united 6 fashion accessory brands varying sizes under one roof. Tapestry's Coach, Kate Spade, Stuart Weitzman, and Capri's Michael Kors, Versace, and Jimmy Choo. The FTC argued that this would create an excessively concentrated player in the quote-unquote accessible luxury handbags market, and the judge agreed. But funny things happened ever since that merger was blocked in October. Tapestry stock has shot up 148%. It's now up 69% for the year, with a big breakout over the past couple of months. So what the heck is driving this amazing move in a stock that previously has spent the better part of the past decade trading sideways? First and foremost, as much as Tapestry, which, by the way, that's the old Coach, wanted to acquire Capri Holdings, Wall Street always hated this deal. Tapestry was going to have to borrow a couple $1 billion, overstretching an already stressed balance sheet, all to pay for a company that consistently has been a much worse operator. Coach has been working very well, but Tapestry's other 2 brands have struggled. And people were worried that the whole business would be derailed if they added another basket of declining brands like Michael Kors. Back when the Capri deal was announced in August of 2023, Tapestry stock fell almost 16% on the news, then languished for over a year as the deal was in limbo. So when that federal judge officially blocked the deal last October, Tapestry rallied almost 14% in a single day. Originally, the companies vowed to appeal the decision, but about a month later, in mid-November last year, they gave up on it for good. And then Tapestry jumped another 13% that day. After officially giving up on the Capri deal, Tapestry did a couple of very smart things. They redeemed the deal debt, easing any balance sheet concerns, and they also announced that they'd be adding $2 billion to the buyback, taking it to $2.8 billion at the time. A couple weeks later, in late November, they announced that they'd actually been doing a $2 billion accelerated share repurchase program. At the same time, Tapestry had a market cap of roughly $13 billion. Meaning management was talking about retiring roughly 15% of the shares outstanding on a pretty rapid timeline. And if you shrink your share count by 15%, then your earnings per share increases significantly. So all the analysts who follow this thing had to raise their estimates. Very positive. At the same time, management said they wouldn't try to make any more acquisitions until they turned around their struggling Kate Spade brand, which is exactly what Wall Street wanted to hear. In February, Tapestry went a step further, announcing the sale of their Stuart Weitzman brand to Calories, which is a footwear company, for $105 million. That thing's been football all over the place. Small deal, but the message is the same. Tapestry's going to focus on their best opportunities, meaning the core Coach brand turning around Kate Spade. Everything else, distraction. And you know what? Tapestry pulled it off, which is why the stock keeps running. When the company reported in early February, after management had begun to execute that accelerated buyback, the numbers started to get really good. Tapestry delivered a substantial top and bottom line beat, management raising their full-year earnings forecast by 25 cents. And in May, they did it again, beating and raising for the 3rd consecutive quarter. Once again, the company posted a top and bottom line beat, and despite all the tariff uncertainty, Tapestry was able to raise its sales and earnings guidance. What's driving this strength? Now, a lot of it is because the Coach brand keeps getting better and better. Coach grew at a 2% clip on a constant currency basis when they reported in November. Then it was at 10% in February. And now it's 15% when they reported the most recent results in May. We've got some accelerated revenue growth going here. Rather than acquiring Michael Kors like Tapestry originally planned to do, instead they're having Coach steal as much market share from Kors as possible. Now, why is Coach winning? I think this is another example of what we have seen in the consumer discretionary space for a while now. Consumers want value, not necessarily absolute value, but relative value. They want high-quality goods at reasonable prices. Nobody would ever accuse Coach handbags of being cheap, but they cost a couple $100, not a couple of $1,000. If you're in the market for luxury goods, then this stuff represents tremendous value. And as the CEO, Joanne Kruvasara, pointed out in the last conference call, they're recruiting a new legion of brand loyalists in the Gen Z demographic, which means the future looks bright for Tapestry's biggest business. Now, the thing that's still missing from the Tapestry story is the term for the smaller Kate Spade brand, which made up about 20% of sales last year versus 76% for Coach. Now, Kate Spade's constant currency revenue growth has declined for 8 straight quarters. Wow. It was down a hideous 12% when they reported in May. Oh, God, that was such a good brand. On the last conference call, the CEO explained that they're trying to turn Kate Spade around by taking the cue from Coach. That includes better marketing, directly going after younger consumers, and coming up with new products to breathe new life into this formerly iconic brand. The way I see it, even with the once red-hot Kate Spade is doing terribly right now, Tapestry's been putting up great numbers, so if they can turn around Kate Spade, man, that would be pure upside. In the end, giving up on the Capri Holdings acquisition turned out to be a brilliant move for Tapestry. Rather than buying a bunch of struggling brands, they made a much better investment in their own stock, sold off the unexciting Stuart Weitzman business, and have turned their core Coach brand into a powerhouse. When your competitors are in bad shape, you don't try to take them over, you just eat them alive, which is what Coach has been doing to Michael Kors. Now, one caveat. Tapestry reports again on August 14th, and given the stock's incredible performance since last October, obviously the expectations here are high. The bar's like this. I don't think the stock is crazy expensive here, trading at just under 22 times this year's earnings estimate, 18% earnings growth. Business looks good. But considering that the stock's up 69% for the year, this quarter, I'm calling it inherently risky. Here's the bottom line. Ideally, I want Tapestry to report a good quarter that doesn't quite satisfy the shareholder base, causing a sell-off that allows you to buy this stock at a lower price. But if you like the story, you got my blessing to put on a small position before the quarter, because from my perspective, Tapestry's management knows exactly what they're doing, and they're doing it well. Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.